I'm Marianne Deveni. Today we're going to take a look at just one chart. I'll call it the chart of the day. And it looks at the Dow back in 1929 and looking ahead to now. What does it mean to your portfolio? Well, I'm joined today by Lewenza, who's Vice President and North American Equity Strategist at TD Wealth. You say this chart has been causing quite a stir. What's up with that?
Yeah, so this chart was recently profiled or highlighted in the Barron's publication. A number of strategists have had to opine on it.
I've seen it on the internet.
Exactly, it's getting, yeah, it's all over the internet right now. And so what this chart is basically an analog or an overlay of the recent trajectory or pathway of the Dow Jones over the last couple of years with the pathway leading into 1928, 1929, just before the Great Depression there. And they fit pretty closely. They're tracking quite closely. And so there are a lot of bears out there that are using this as ammunition in basically saying that there's going to be an imminent collapse because they're so closely correlated and tracking one another.
But it's not all it seems.
No, I have a lot of issues, a lot of kind of counter arguments with this thesis. So number one, looking at it from a fundamental perspective, a very different fundamental backdrop today than back then. So there we would look at, say, the Federal Reserve. In 1928, 1929, the Federal Reserve actually increased interest rates. They become more restrictive. And we've actually done the exact opposite. Ben Bernanke, a student of the Great Depression, basically studied that period and again did a 180 from that. And basically there he lowered interest rates. He injected a massive amount of liquidity into the financial markets. So again, a very different backdrop.
It's almost opposite.
The opposite. And so what else is different? A number of key factors. Right now, we've had our huge decline in the stock market. We had arguably the bubble, the housing bubble that took us into 2007, 2008. We had the recession and big sell-off in the stock market. But now we're coming out the other side. And I actually think this chart is looking at apples to oranges because the 1928, 1929, that was before the Great Recession or Great Depression, and it was before the big meltdown of the stock market. So you're not really comparing two really closely linked periods, in my view. And there's a number of other things that make me kind of disagree with this thesis. The scale of this chart is completely different. And what I mean by that is the run-up that we had in the S&P last year, a huge run-up, had about a 30% gain. If we look at 1928, 1929, the Dow Jones rose over 90% before it peaked out. So the scale is quite different. The fundamentals are quite different. And then lastly, I see these analogs or these charts where they put two different time series together. I see them a lot. And you know what? Often they work until they don't. So they'll work, they'll be quite closely correlated, and then ultimately breaks down, and I think that's what's going to unfold here. So when we look back, yes, right now it is tracking, but the fundamental backdrop incredibly different, and therefore we don't think that there's going to be an imminent sell-off, a major sell-off in the stock market.
And really the question when you see one of these charts you have to ask is why? Right. Why is it like this? Why is it not like this? Right. What's different than before? Let's look at what's now. What's now then? What are the technicals telling you?
If we look at the technicals in the stock market, starting first with the S&P, they're very bullish right now. We've got the S&P in a confirmed long-term uptrend. Even with the recent pullback in the S&P was down about 4 or 5%. It held that trend line, so still in a long-term uptrend. We're above key moving averages, so we're above the 50 and 200-day moving average. And if we back up a little bit, I like to look at a weekly chart. We're above the rising 50-week moving average, so we're in a long-term, still a long-term uptrend. If we look at other secondary technical indicators, one of the things I really like to look at is the NYSE Advanced Decline Line. This looks at advancers versus decliners, and it's basically an indicator that captures market breadth. And that continues to make new highs, so that shows that there's good participation in the market. So when we look at the S&P, we're in an uptrend. The advanced decline line continues to move higher, so that looks quite bullish to us.
What about January? Was that a bit of a pullback there, or is that an anomaly?
Well, that was a pullback. We had again a huge run up, 30% for last year, and we were technically overbought, and we got a little bit of pullback. There were some concerns around the emerging markets. The Fed is starting to taper, so we were actually calling for a bit of a pullback in the beginning of this year, and that seems to have played out. So for this, that's just a small little pullback within the context of a long-term uptrend.
So you're not expecting a bigger one?
No, we're not. So it's not to say that we couldn't have a little bit more, a little more choppy trading here and there. Right now, some of the global equity markets are technically overbought. For example, if I'm looking at the TSX, right now, if I'm looking at the RSI, Relative Strength Index, which captures this overbought, oversold, right now we're at 72, over 70 is overbought. So we could get a little bit of a pullback to work off that overbought condition, but let's just step back a little bit. Look at your long-term charts, higher highs and higher lows. Good market breadth. The stock market still looks pretty good to us right now.
So where are you, what areas are you looking at? What sectors?
So our preferred sectors for this year are industrials and financials. We still very much like the healthcare, and we've been overweight that for some time. So if we look at the financials, industrials, well, why do we like that? Well, first, we think economic data has been very weak over the last little bit. We look at non-farm payrolls coming in quite weak, ISM quite weak, and we think that is a combination of two factors. Number one, there has been a very clear pattern that economic data has basically rallied into Q4, then has weakened into Q1, and generally troughs in the summer, in the spring-summer period. We've been seeing this pattern the last 3-4 years. We think that's playing out again. And second, the weather. The weather has been impacting economic activity for sure. So we think economic activity is going to trough in the spring, and therefore we'll start seeing better economic releases that should support industrials and similarly financials. If we're correct that data should improve, the yield curve should steepen, the 10-year treasury should go higher. That should support higher net interest margins for the banks and higher earnings. So those are our two cyclical sectors. And again, we still like the healthcare, which provides a bit of balance to portfolios.
And on the earnings front, we've seen pretty good earnings, not bad. No, would you agree?
I would say they were very strong. And so if we transition in comparison to recent quarters, so we were just talking about technicals, let's transition over to the fundamental side. And I would argue that this has been the strongest earnings quarter in over 2 years. And frankly, I don't think it's getting enough positive press. So why do I believe that? So let's first look at growth, year-over-year growth rates. S&P earnings are going to come in around $28.30 for the quarter per share. On a year-over-year basis, that's 13% growth. That's the highest earnings growth rate we have seen in over 2 years.
And is this year over year or versus what analysts were expecting?
This is year over year comparison.
So that's pretty nice.
Yes, and they did come in above expectations as well. So we had a beat relative to expectations, but more importantly, year over year we saw good earnings growth. On the top line, which continues to be a bit of a challenge, they were up, revenues are up about 3%. So given that revenues were up 3, earnings were up 13, there must have been some margin expansion. And net margins did expand yet again in this quarter. So we had good earnings growth, we saw net margins expanding, and also we saw good breadth, meaning a number of companies, a plurality of companies were beating the consensus estimates. So there, 74% of the companies in the S&P beat the consensus estimate. So when we look at this quarter, we would give it probably a B+.
All right, thank you very much, Ryan.
All right, thank you.
I've been joined by Ryan Lewenza, who's Vice President and North American Equity Strategist at TD Wealth. Thanks for watching.